Wall Street got the inflation relief it wanted, and stocks responded by pushing the S&P 500 to another intraday record. July producer prices were flat, and traders increased the odds that the Fed holds rates steady in September. That sounds like easier money. But the bond market left a very different receipt on the table. The latest 30-year Treasury auction cleared at 5.206%. That is the auction yield on that specific long bond, not the borrowing rate for every household, company, or Treasury security. Still, it matters because it shows how expensive long-term government funding remains. Wall Street got the party balloon. Treasury got the dinner check. This is the risk setup. Short-term rate expectations can improve, while long-term borrowing costs stay stubbornly high. Softer inflation can reduce the pressure for another Fed hike, which helps stocks, especially long-duration assets like technology. But the 10-year auction this week also came at its highest yield in nearly 2 decades. The long end is not exactly joining the celebration. Why should equity investors care? Because long Treasury yields sit underneath a lot of the financial system. They influence mortgage rates, corporate borrowing costs, and the discount rates investors use to value future earnings. A company can deliver great growth, but if the hurdle rate stays high, those future dollars are simply worth less today. The market can have a friendlier Fed story and still carry an expensive cost of capital problem. That does not mean a crash is coming. One auction does not prove a debt crisis, and elevated yields can coexist with rising stocks for a long time. The question is whether the relief broadens. If 10-year and 30-year yields keep falling while equity breadth improves, the market is telling you financial conditions are genuinely easing. If long yields rise again while the Fed stays on hold, then the debt tab is still sitting there, quietly getting harder to ignore. The next test is July retail sales, due Friday morning in the US. A strong number could revive growth and inflation concerns and push the long end higher. A softer number could take pressure off yields, although very weak data would create a different problem. Watch the 10-year, the 30-year, the dollar, and whether gains spread beyond the biggest technology names. So the calm read is simple. Record highs are the surface. The message underneath is whether the cost of money confirms the rally. Wall Street can celebrate softer inflation, but until the long end starts picking up part of the check, liquidity relief is still incomplete.